Welcome back, ladies and gentlemen. I hope that you enjoyed the lunch. And to help you get over the post-lunch coma that you might be experiencing now, we will have the next panel, which deals with what exactly gives cryptocurrencies value. Now, I can't promise that it will be a light topic, but I can promise you that it will be an interesting one. So without further ado, let me first introduce the panelists. To my left, we have Torbjørn Jenssen. I hope I pronounced that right. Who holds a master's degree in economics from the University of Oslo. He specialized in micro or macro finance and statistical methods. And his master's thesis was on why bitcoins have value and why governments are skeptical. In this thesis, he investigated Bitcoin from a political economy perspective, drawing on insights from research theory, institutional economics, and monetary theory. He currently works as a senior economist at Menon Economics. And then to my right, we have Voldsgaard, fellow Dane, who is writing his master thesis about modern monetary systems at the University of Copenhagen. Specifically doing studies on the monetary system from an institutional point of view, namely how central banks and treasuries interact with the private sector in financial markets. He has also been involved with the Danish Bitcoin debate as a somewhat critical voice. And finally, allow me to present myself. My name is Morten Clausen, and I work in Brussels for Europa, which is one of the European trade union federations. I work on financial regulation and represent financial employees across Europe. Given the potential changes that fintech and cryptocurrencies can have on the financial system, these are topics that we follow quite closely. So I'm looking forward to the presentations that we will hear today. And so before we begin, let's take a quick look at the current state of cryptocurrencies. As it stands at the moment, there are about 3,500 cryptocurrencies in existence. Now we can debate on what exactly makes a cryptocurrency, but at least one of the general views is that that is the number. The largest ones being Bitcoin, Ethereum, and Ripple. So on the one hand, we have currencies that can easily be acquired all over the world and used everywhere. They are outside of government intervention and were, at least initially, intended to provide a more decentralized and democratic means of payment for individuals. And on the other hand, we have currencies that are often accused of being vehicles for money laundering, excessive speculation, tax evasion, and are associated with some serious risks, especially for people new to the digital currency system. Here I'm especially thinking about companies that defraud investors in initial coin offerings, or ICOs, often benefiting from novices being lured in by rumors and hopes of high profits. Just last week, I was reading about a company in Vietnam that managed to raise about $660 million in two ICOs, and then suddenly they just disappeared off the face of the earth. People are not too happy about that, obviously. Likewise, there have been examples of quite large amounts of bitcoins having been stolen from crypto banks or disappearing with bankruptcies. In this case, I'm thinking about Mt. Gox in 2014, where about $473 million went down once the company went bankrupt. And the Tether cryptocurrency, which was hacked last year to the tune of about $31 million. So while the development and use of cryptocurrencies will not be stopped, there are also some tangible dangers associated with their use. And the way that governments around the world have started to deal with these currencies is quite diverse. While some are actively embracing them, others seem to want to prevent their widespread usage as much as possible. Where some intend to implement their own digital currencies, others see them as threats to the ability to implement economic policies and want to retain the right through the banning of cryptocurrencies. Japan is one example, which is quite positive towards cryptocurrencies and initial coin offerings, and they want to see this market expand further. So they have started to implement guidelines on ICOs, aiming at protecting investors and preventing money laundering. These guidelines are planned to become law within the next few years. However, they are quite in contradiction with other countries' policies, such as, for example, China and South Korea, which currently has banned initial coin offerings. In Russia, the ownership of cryptocurrencies is legal. However, their use for buying any products is banned. And Poland, on the other hand, has decided to start levying a tax on all cryptocurrency transactions, regardless of whether it makes a profit or not. And in the US, Bitcoins are now subject to capital gains taxes. Staying on the US case, the Commodity Futures Trading Commission, mouthful, has regulated and may continue to regulate virtual currencies as commodities. The Securities and Exchange Commission also requires registration of any virtual currency traded in the US, if it is called or if it is classified as a security, and of any trading platform that meets its definition of an exchange. The regulatory structure also includes tax regulations and transparency regulations between financial exchanges and the individuals and corporations with whom they conduct business. Meanwhile, in the EU, there is more of a vacuum at the moment. While the EU has not regulated the use of cryptocurrencies, it has been indicated by the European Commission that legislation may be on the way, and especially regarding anti-money laundering, or AML, attention is being paid to the loopholes that have been created by cryptocurrencies. Central banks of the European member states do not consider virtual currencies as equivalent to money, and they are not treated as legal tender, as far as I know at least. In many member states, there are also no specific virtual currency regulation, and in many cases only a series of opinions and warnings have been issued by the central banks or the regulators. Germany, which currently has the most elaborate rules, consider virtual currencies as units of account, which do not confer them the status of legal tender. Finally, countries such as Sweden, Russia, and Israel are all looking into creating digital versions of their currencies, clearly believing in the mantra that if you cannot beat them, join them. So in view of these facts, I will now turn the floor over to our speakers, as they will tell us more about what, in their view, gives cryptocurrencies their value. And so we start off with Torbjørn, who will give a presentation, I understand, especially focused on Bitcoins. So over to you.
Thank you. First, I have to express my appreciation for being invited here and for Rethinking Economics hosting this great event with these very important topics. I'm going to focus my talk about Bitcoin because the term cryptocurrency has become so wide and covering so many different objects that it is more or less meaningless. And also Bitcoin, by being the most ubiquitous of the cryptocurrencies, and also the largest and easiest to understand, I think it makes sense to talk about that. But before I go into my presentation, I think I should give you a little bit background on my background, or like talk a little bit of my background. So I used to study economics at the University of Oslo. I was doing this 5 years professionals degree where you do 2 years of undergrad and 3 years of masters. And I was very happy with the courses I had at Blindern. I learned that money might pop up in the utility function in some neoclassical model, but it doesn't really do anything there. And in monetary economics, I learned new Keynesian models where I could model money without having money in the model. And I was very happy with that. But for some reason, something inside me must have wanted more. Because I decided to do an exchange year to SOAS at the University of London. A school very well known for its diversity or its diverse approach to economics, teaching the students about all the different, at least not a lot of the different theories. And some of my teachers were very focused on money. And they learned me that money is anything but neutral. It really, there's loads of different theories, and money is very important in the workings of our economy. So I decided that I wanted to replicate this paper from the IMF where they looked into narrow banking, where they had a DSG model and simulated what would happen to the economy if you imposed narrow banking. And I wanted to replicate that for Norway. But then a friend of mine told me about this weird thing called Bitcoin. He told me to invest. A Bitcoin was worth $60 US, and I said, no, this is crazy. I regret this to the day, when Bitcoin right now is priced at $6,000 or $7,000. But even though I kind of didn't believe in it as an investment back then, at least, it caught my interest. So I decided to do my thesis on Bitcoin, trying to see how the different theories I had learned about money, the Austrian theories, the chartalist theories, the metalist theories, how these could be used to try to analyze Bitcoin. And I think it's very important to understand what Bitcoin is and what cryptocurrency is before you jump to any conclusion regarding whether it's good or bad, whether you should regulate it and how you should regulate it. So I think we should start with the fundamental question, what is Bitcoin? And to understand what Bitcoin is, it's really important to know that this term is used to mean two different things. First, it's used as the name of the system, the network for value transfer, Bitcoin with capital B. It's also the name of this object circulating in this network. And the network and the currency is, they are linked together. They cannot exist without each other. The network doesn't work without the monetary object. The monetary object doesn't work without the network. So as a system, what is Bitcoin? Well, technically speaking, it's an infinite, time-respective, consensus-based cryptographic state machine, or a system which enables magic internet money for most people. No, I changed my slides. Well, it'll come later. As an economist, on the other hand, I like to view Bitcoin as a ledger, as a bookkeeping system. But that's not unique to Bitcoin. That's true for any monetary system, any value transfer system. What is unique to Bitcoin, though, is that it is nobody who controls the system. It's organizationally decentralized. There's no one who can say what software the user should run. Yet at the same time, everyone shares the same global view of the state in the system. There's no disagreement about who owns how many Bitcoins, yet nobody controls the system. And this is a kind of system that we never had before in a digital world. We never had a system which nobody controls, but it's the same to everybody. And if nobody controls it, a very natural question to ask is, what makes it secure? When you don't have a middleman ensuring the integrity of the system, how can you know that the balances are correct? And the short answer to this question is the immense amount of resources going into mining. People think that you mine primarily to get Bitcoins. Well, that's the economic motivation for miners. But for the system, it's this resource cost which makes it robust, makes it secure. Because if you want to game the system, you have to put up more resources than all of the other miners to change an old transaction. If you cannot do that, or if you find it unprofitable, you'll not change the system. But if this was the only thing keeping Bitcoin secure, that would mean that the miners could control the system. And with increasing returns to scale in mining, that would eventually lead to centralization. Luckily for Bitcoin, the true security model is derived from the separation of powers between the different kinds of actors in this system, between the developers, the users, and the miners. Not too different from the optimal separation of power in a democracy described by Montesquieu. And to understand this, it's nice to explain it by an example, board games. So Bitcoin is a software that you run on your computer. It's defined by its set of rules as a protocol. In the same way a board game is defined by the rules defining the game. There's nothing in these rules that decides how you can change the rules. There's nothing in the rules of Monopoly that say that you cannot play risk. The users decide what software to run. The users, in the same way, they decide what game to play, what rules to follow. Miners are those who enforce the rules because they're paid for doing so. It's the users, the investors, which make Bitcoin have a monetary value so that miners can pay their electricity bill. So the miners come where the users are because that's where they're paid, and they enforce the rules because they're paid. The developers are those who come up with suggestions to new rules, to updates, or other games. If the users try to impose a rule where they stop paying the miners, there will be nobody mining, the security of the system will evaporate, and the system won't be very useful. So the users cannot leave the miners behind. If the miners, on the other hand, try to change the rules in a way that the user doesn't like it, you'll have a split. You'll have two networks, one where all the miners are and one where all the users are. If the users stay on that network, that's where the currency, where the Bitcoin will be valuable, be possible to use to pay your electricity bill. So the miners will be forced to come back to where the users are. So the miners cannot leave the users either and impose their will. And lastly, since this is software, you really need a dynamic development community to continuously upgrade this, to continuously build on this. So you really, really need to have a strong development community as well. This makes the miners, the users, and the developers mutually dependent. And this is what makes the system really robust. So that was a short introduction to how Bitcoin works as a system. How about Bitcoin as a monetary object or a value object? Well, here is the magic internet money. To most people, that's what they think Bitcoin is, or a vehicle for criminals. But Bitcoin can also be understood as something very different. Satoshi Nakamoto, the guy who came up with Bitcoin, had this thought example or thought experiment in a blog post very early on. What if Bitcoin was this kind of base metal, scarce as gold, but with the following properties? Boring in color, not a good conductor of electricity, not particularly strong, but not easily malleable either, not useful for any practical ornamental purposes, not useful for anything. But you could transport it over a communication channel. Could that obtain any value? Could that become valuable? Could that start circulating as a form of money? Well, we know that this has value right now, but how can this be? If you look at some of the theories of how money, or like the origins of money, and you make a broad divide, you have on the one hand a very market view associated with Carl Menger and people who think that money is something emerging from the market. And they tend to focus on some kind of good having some kind of intrinsic value, a value which you can consume if you were on a lonely island. And then that good can start circulating and get a secondary use case, which is as medium of exchange. And then, for instance, Mises, with his regression theorem, explained how the network's effect over time could make a good with originally inherent value deviate from its original value and becoming a medium exchange. But it had to start with some intrinsic value. On the other hand, you have this credit theory of money, state theory of money, saying that money is always originating from debt, from power relations, and especially from the power of the state or the church or other central entities. But how does Bitcoin fit into these two narratives? Well, actually it doesn't really. Krugman's here, for instance, he's claiming that Bitcoin must be a bubble and its real value must be zero because you cannot pay your taxes with it. There's no government backing it. So therefore it cannot be valuable because you cannot eat it. And if there's no government behind it, it can't be valuable. There are some places where you actually can pay your taxes in Bitcoin, but not many. On the other hand, you have Alan Greenspan, who thinks gold makes great money because it has intrinsic value, but who really can't wrap his head around how you can infer any intrinsic value for Bitcoin, because what should you do with it? You cannot do anything. It's purely digital. It's not beautiful. It doesn't conduct electricity. There's nothing you can do with it. And then you have Schiller saying that, well, Bitcoin is likely to collapse totally because it only has value if there are some common consensus that it has value. And according to him, that's unlikely. But really, is it so unlikely that there can be some common consensus that Bitcoin has value? If you look at what's called the search theories of money, for instance associated with Kentucky and Wright, they've figured out that objects without any use value, but which are storable and easy to transfer, very often in game theoretic settings and also in simulations and in experiments, start acquiring a monetary role. And this is about scaling social cooperation. If you look at primates and the relationship between the size of the neocortex part of the brain and the average size of a group, you find humans with the largest neocortex brain with an average group size of 120, which means that humans are capable of interacting in groups of 120 people, know each other well enough to actually interact, but we cannot handle larger groups than that. So we can have some division of labor in a group of 120 people, but not much. So we need something to make us able to scale to interaction between larger groups. And this is where money, as transferable proofs of works, come in, where jewelry is transferable wealth. Because if you look back 75,000 years in some caves, what do you find? You find these seashells, so being collected. You find different kinds of beads, different kinds of teeth, which are stored, and it looks like jewelry. But from an evolutionary perspective, these have been societies living on subsistence level, yet they've been using loads of energy producing these useless or collecting these useless things. And the reason they did that was because they could use them as money and thereby interact in indirect value exchange. And the interesting thing here is that if you look at the Marxist theory of value, the labor theory of value, these objects are actually valued for the kind of the amount of work that's required to obtain them. So I'll give you some examples, because this might sound pretty weird. The stone money of Yap is a very famous example. On Micronesian islands, where these huge rocks were used as a store of value, and sometimes as a medium of exchange and a form of money. On Yap, this stone cannot be found on Yap. What the Japanese people had to do was to canoe over to another island and quarry these stones and carry them back. This was a very, very difficult process. But by having these scarce objects, which were provable, costly to get back to the island, they could start obtaining a monetary value. The funny thing about these stones, though, was that since the community in Jap was so small, they had a memory of who owned what stones. So when they transferred them, they didn't move the stones. They just told everyone that now there's a new owner of this stone. Also, when more modern ships came and it became easier to acquire larger stones, those stones were not valued as highly as the older stones, which had costed more work. Other examples from a bit newer time. Somali shilling. The Somali government collapsed in the early 90s, and together with it, the Somali central bank. Yet the Somali shilling continued to circulate. And warlords in Somalia started importing new shillings. They couldn't add zeros to the notes because people would only accept the highest denomination of the previous central bank. But it was cheaper to import notes than the purchasing power. So you had a long period where more and more notes were imported, and the value of the notes fell until in 2009, when the value of the notes hit the marginal cost of the paper of the importing. And you suddenly had full price stability. These notes circulated without any government backing, without any central bank for more than 10 years. Another example is the Iraqi Swiss dinar, which was demonetized by Saddam Hussein, but continued to circulate in northern Iraq, in the Kurdish part, long after it was demonetized. And since you couldn't import more, you had, and the money deteriorated over time, it started appreciating because you had a fixed supply. And the point here is not to say that all money is proofs of work or commodity monies, as these are. But it is to point towards that there can be money. And then the big question is, when does these kind of monies that acquire moneyness just by being scarce, become money? And as it turns out, that depends on the institutional setting you're in. If you have zero trust, if you don't have any institutions ensuring trust, you have to interact in direct barter. You have to exchange something of value right there and then with value. If you have a little more trust, not much, if you have a little more often interaction between different groups, between people, a commodity money can start functioning as money. It's nobody's debt, but it's a scarce object which can serve as an indirect record of who has purchasing power or not. In more stable societies, fiat money issued by a state can emerge. If it becomes even more stable, you have a rule of law, you'll see credit money emerge. And within a family or within a factory, you use a perfect record, you use memory. You don't use money within a company. So my point is that we will see all these kind of monies circulating in parallel, dependent on what kind of interaction they are intermediating. So then the big question then is, or becomes, so Bitcoin, as this digital version of a commodity money, limited in quantity, where does it lower transaction costs, which other monies cannot? Where does it have its use case? And it turned out Milton Friedman had a prediction in '99. He understood the power of internet, but according to him there's one thing missing, and that was a reliable e-cash, a method whereby on the internet you could transfer money from A to B without A knowing B or B knowing A, exactly the same way you could do with a $20 bill. And why on the internet? Well, on the internet, you don't know who you're interacting with. You don't know if it's the same person as last time. You don't know if it's a dog. And what Bitcoin does, for the first time in history, is enabling trustless digital value transfers. Of course, as long as there is some common consensus that Bitcoin has value. And this common consensus started in 2010, when a pizza dealer accepted 10,000 Bitcoin as the payment for 2 pizzas. This is if you do the value regression in a Miesian way, backwards from the price today, you'll end up with these 2 pizzas. A leap of faith, a tricky strategy. Money doesn't have to start with intrinsic value, value you can consume in isolation. It can start with a leap of faith. So now that we have this scarce digital valuable object called Bitcoin, what can you do with it? Well, as it turns out, there are satellites covering most of the surface of the Earth, giving access to Bitcoin's network, which means that with a dish and a USB cable, equipment with the cost of 1,000 kroner, you can send Bitcoin without any hint of internet connection. You can send money to whomever you want, in what quantity you want, whenever you want, without asking anyone. And that can be very useful for the 2 to 4 billion people in the world who lack access to electronic payment. You could think that these people lacked access because they lacked access to technology. But according to the World Bank, these people are excluded from modern electronic finance because the centralized electronic payment systems are put under so strong regulations, anti-money laundering, anti-terror financing. These regulations have their cause, there's a reason why they're there. But the billions of people who are excluded because they don't have a fixed income, because they don't have a stable address, they don't have a saying in the countries who impose these regulations. And they will seize opportunities to participate in a digital global economy. There's technically nothing stopping a Bangladeshi person from programming a web page for a person in Venezuela. But there's no way to process the payment unless they use Bitcoin. And it's not only within poor countries, finance really doesn't work well. Also between countries, payment can be very expensive, very difficult. EU has reduced its sanctions on Iran. So Swedish government doesn't have anything against Swedes investing in Iran. Yet at the same time, the US and Trump has increased their sanctions, which means that as a Swedish investor, when you go to your bank and ask them to transfer money to Iran, your bank will say, sorry, we're afraid of sanctions from the US government. A fund in Sweden came up with a solution. What if the investor buys Bitcoin for Swedish kroner, send the Bitcoin to Iran and sell it in Iran at a pre-agreed price? Then you're not exposed to the crazy volatility of the Bitcoin, but you can get money from Sweden to Iran because this is digital money which is nobody's debt. This is digital money where the value is in the token itself. When you're transferring money through the banking system, there's a chain of banks which has to accept a claim on each other. And if just one of those banks charge a very high fee or block the payment, the whole transaction is blocked. But there's no blocking with Bitcoin. There's no blocking of WikiLeaks either. In 2013, it became impossible to donate money to WikiLeaks. It was never an illegal organization. There was never any court case saying that the WikiLeaks should be blocked or have their accounts frozen. But the government of US had 3 doors to knock on: PayPal, Visa, and MasterCard. After this, WikiLeaks started accepting donations in Bitcoin. But this is just some of the few things you can do with Bitcoin, a digital commodity money. The real power is in how the network powered by Bitcoin can be used for other purposes, forms a general digital infrastructure for value transfer. So you have what's called on-chain transactions. That's when you use Bitcoin's core system as a payment layer. That core system doesn't scale very well. Transactions in the core is stored forever on thousands of computers all around the world, makes it super robust, super secure, relatively censorship resistant, but it's very inefficient. But the beauty of this is that since this is completely predictable, like a court system which will make the decision the same way every time, that allows you to handle a lot of the transactions outside of that system without the counterparty risk, because you know that if something breaks down in your transaction outside the system, you can always settle in the core system. This allows for off-chain transactions without counterparty risk, where you can stream money using the Lightning Network. You can send micropayments as fast as you can send music. You have sidechains, where you can take Bitcoin out of its system into another system and program it, putting it into smart contracts, giving it other functionalities. That's very tough to do with bank money, because you have to ask for permission. If I want to make an innovation where my solar panel sells electricity to my neighbor, I have to go to the bank and ask if I could maybe get access to their backend. And they'll say either no or they'll buy me. The other interesting thing is that the Bitcoin network, being made secure by the mining, incentivized by this cryptocurrency, can be used for other assets. You can use it for what's called color coins or asset-backed tokens. And you have loads of projects where you issue an asset or a token of an asset on the Bitcoin blockchain, which then can circulate on a global secure payment network. The thing is that when you do that, even though that asset might be a Norwegian kroner or might be a stock or a bond, every time you transfer it, you have to pay a transaction fee denominated in Bitcoin. This drives a kind of industrial demand for Bitcoin, because when you want to use the blockchain for other purposes, you have to pay for that in Bitcoin. You can also use the Bitcoin blockchain to secure other systems. Electronic IDs which are self-sovereign. If you think about what an electronic ID is, it's the connection between a secure public cryptographic key and a human readable name. Torbjørn, and something absolutely not readable but secure. Until Bitcoin, that list of human readable and digital secure had to be stored by a central authority, had to be stored by Facebook, centralizing digital identities, forcing us to use Facebook, for instance, or Google or Bank ID when verifying digitally who we are. But if you put that list in the Bitcoin blockchain, you pay the transaction fee to write it in, and from then on you can read it out forever, then you can have self-sovereign IDs. Then you can have a Facebook where all the data is stored by the user themselves, where you don't have a man in the middle. And that's only possible because the Bitcoin as a value object, as a currency or whatever you like to call it, is decentralized. And what we're seeing now is that the Bitcoin system, where the Bitcoin value object is the oil, starts to form this base layer of our software stack, the same way that TCP/IP is at the bottom of our internet. If we only had TCP/IP, internet wouldn't be very interesting. But because we have other protocols built on top of it, HTTP giving us web pages, voice over IP giving us Skype, we've been able to develop apps at top of the internet, apps that functions because the underlying protocol works. Nobody knows really what's happening when you're using your app, but they work because of the internet being the TCP/IP functioning at the bottom layer. In the future, we'll have the same built atop of the Bitcoin blockchain, powered by the Bitcoin currency, where we'll have apps where the users will have no idea what's going on behind the screens, but the capabilities of the app will be dependent on the decentralized value network at the bottom layer. And this is starting, like companies like Microsoft are starting to discover this, that the Bitcoin network can be used for way more than money. And even if it's just used for money, it's very, very powerful for those situations where we don't have the institutions that provide trust, or where those institutions we have limit people's access to participate in the economy. So digital commodity monies that are just scarce, such as Bitcoin, they have value because they solve real problems, enables transactions as no other monies can. That's the reason why they have value. That's it.
Hello, everybody. Is it working? Yeah. I'm happy to be here. Thank you for hosting me. Rather than focusing on the technical difficulties which Facebook Bitcoin faces due to its software design, I'd rather focus on the more difficult question of what is money, what is the purpose of money, which Rowan Gray spoke about earlier. As a political scientist by training, I'm interested in how stories about our money shape how we think of what makes money today, and also can Bitcoin become money, our normal means of payment. Because how economic science has evolved since the 70s, money has been politicized. You've all heard that the notion that money is neutral. I'm happy to hear that that Torbjørn recognizes it is not. And basically, I share Rowan Gray's approach to the history of money, namely the chartalist position that Torbjørn also sketched out very briefly. I have two purposes with my presentation here. The first is to review the two theories of money which seem to be shared among Bitcoin proponents, and I'll seek to add some historical, political and anthropological context to these. The first one is that money is a market exchange phenomenon invented to reduce transaction costs. I'll argue that this theory is doubtful in light of historic accounts. And second, the notion that money is memory, or put in another way, a record of past contributions to society. And I will argue that this view is missing the fundamental feature of our monetary system. That is, it is essentially a web of debts and credits. Lastly, I'll hope to convince you that these monetary theories give Bitcoin proponents a false hope of its future as money, and that if we get a better understanding and utilization of our monetary system, we'll be better able to achieve our social and political goals with society rather than by transferring to a Bitcoin system. So the first theory of money is that of money as a market exchange phenomenon. You've probably heard of when being told what is money, you've been presented with the three functions of money, that it is a unit of account, a store of value, and a medium of exchange. And these three functions serve to limit and reduce transaction cost. So this is pretty much a functionalistic explanation of what money is. Money is what money does. In standard macroeconomic textbook, such as Mankiw's that was mentioned in the earlier session, his popular principles of macroeconomics, you find the same story of monetary evolution, which underpins the foundations of neoclassical economics, namely the history of an evolution from a barter economy towards the current fiat economy, which we are situated in today. It's a linear five-stage evolution, which is essentially a story of continual reduction of transaction costs. The first is when you have the barter economy with no money, and without money, two persons would have to desire each other's commodities of equal value in order for transactions to occur. There would be a need for a double coincidence of wants, it is claimed. Then at some point, eventually people realized that they could stockpile popular goods, and those with intrinsic value that they were certain that other people would accept in transaction, and eventually precious metals would be the most suited for this purpose, as they do not lose their value over time. And when this metal-based economy is found, then there's a role for states and political authorities to enter the stage to standardize the metal and in coinage, and ensure that they have equal weights and purity, which makes this even further easier to transact. Governments may then also accept gold in exchange for gold certificates, paper notes, and credit money, thus convertible into gold, the gold standard economy. And lastly, quoting Mankiw, finally, the gold backing becomes irrelevant if no one ever bothers to redeem the bills for gold. No one cares if the option is abandoned. As long as everyone continues to accept their paper bills in exchange, they will have value and serve as money. So this is kind of an infinite regress argument that if you will accept it because another person will accept it, and he will accept it because a third person will accept it. So there's a kind of circular reasoning to all of this, that we have trust in fiat currency because people have trust in fiat currency. And it's implied that this is a very fragile state, that it could, out of nowhere, possibly evaporate this trust. And people point to Zimbabwe, for instance, to show how fragile it is if you don't watch out. So basically, this five-stage story is used to support the foundational axioms of neoclassical economics, that money is neutral to economic activity in the long run. It's a veil over the underlying barter economy. So to sum up, this is money is thought of as a market exchange phenomenon, and states come in at a certain point to assist the market exchange. An inherently functionalistic explanation. But what would be more interesting is not what money does, but rather what is the purpose of money? What is money, these monetary instruments? Which take me to which conclusions a Bitcoin proponent would draw from this thinking of the ontology of money. One might think that another good may take over the role as a medium of exchange, like more or better mediums of exchange have done earlier in history. Furthermore, Bitcoin may become general money if it reduces transaction costs sufficiently. This could be by eliminating third parties that we trust today, which pays their salary through the financial system. And there's this hurdle that the network effects that is currently keeping up the value of fiat currency could be working against the adoption of of cryptocurrencies such as Bitcoin, but and hence when the price goes up of cryptocurrencies, cryptocurrency proponents see this usually as a signal of the coming adoption of cryptocurrency rather than a speculation phenomenon. This has changed in the spring, though. But let's look at some more historically based evidence. Caroline Humphrey, the anthropologist from Cambridge University, wrote in an article that from 1985 that no example of a barter economy, pure and simple, has ever been described, let alone the emergence from it of money. All available ethnography suggests that there has never been such a thing. So this puts the whole story into a shady light. But what else has our sciences of history and anthropology produced of knowledge? Our oldest historical records are actually records of credit. We see the Shubati. It's a record of how the palace, on a clay tablet from Mesopotamia and the Babylonian empires, how the palace authorities recorded what they had bought from the populace, and these clay tablets, the Shubati, could circulate as money, the IOU of the central authority. Furthermore, credit has thus predated coinage by at least 2,500 years, as the first coins are estimated to originate in Greece 600 years before Christ. So this whole notion that that first came commodity money and then came coinage and then came credit is further more shady. Another peculiar thing is that coins mostly circulated above their metal value, meaning that the purchasing power of coins could not have been based on the metallic content, neither of the gold coins. Most coins from medieval times had no numerical value. There was usually just the stamp of the king on it, and the king would announce by a declaration what a coin was worth. So there cannot have been the metal content has been a floor for the value of the coins. Obviously, if the value was cried down by the king to below the metal value, they would disappear from circulations as they would be melted into precious metal for other purposes. Furthermore, the reason why we have coins in our museums is that they didn't circulate very much. Coins are worn down by circulation, but a more normal way of a more normal mean of transaction were kinds of tallies, like the tally stick we have down here. There was also bills of exchange, various kinds of IOU instruments signifying a debt between two persons in the economy. Rather, the historical evidence points more to support the story that you heard Rohan Gray describe earlier in more general sense, but this is what can be traced in the actual process of history, namely that of the school of chartalism, that money has always been credit tokens and accounting creatures backed by a central political authority, and that is taken as in post-tribal societies where the kind of economy was more based on reciprocity. The more plausible explanation of money is that political authorities have imposed taxes and fines in its own unit of account and issued the money token corresponding to this unit of account. As Rohan mentioned earlier, he would not, the ruler would not impose taxes in order to get his own IOUs tokens back in order to be able to spend more, but rather it is a clever way of provisioning for the government and its armies with real resources. Because by routinely demanding the population to pay the government's IOUs and taxes, there would be a continual demand for its IOU tokens, meaning that if you want an army provisioned while it was going to war, you could give them IOU tokens, and the local populations which had a tax obligation would offer the armies real resources for these tokens. So in this view, money has more been a generator of market economies rather than a product of market interaction, because people would offer goods and services to governments and citizens to obtain the monetary token accepted as tax payment. And thus, from this reading of history, there might be others. I find this one most compelling. We would conclude that taxes drive the currency. This is a sufficient explanation of how you get money to circulate or tokens to circulate as money, but there can be instances like in Somalia or with the after the breakdown of the government, where peculiar instances occur, where these, due to culture and habits, they continue to accept them as payment, even though they're not being taxed in them. This whole story of that taxes drive currencies was on full display a few days ago when Reuters reported that due to the gains U.S. citizens had made on cryptocurrencies, they would face a $25 billion tax liability. What does this mean? It's a pure signal of that the taxes drive the US dollars, because even though the persons who prefer to own Bitcoin in some sort, they are being forced to demand US dollars. So this ensures the continual demand for US dollars in the economy. And this is what happens every day. So to sum up, state money is essentially tax credits to the non-government sector of the economy, and state spending finances tax payments rather than the other way around. So with this reading of history and this understanding of money, you get some other conclusions for the future of Bitcoin, rather than what you get from the market theory of money, namely that fiat currency will remain the primary money as long as taxes are imposed in the government's own unit of account. So as long as the Norwegian government demands the Norwegians to pay in Norwegian kroners, the Norwegian kroner will be the most sought after monetary instrument in Norway. And this raises the question for Bitcoin provenance, which I hope we could engage in debate on later. Why would governments want to accept taxes paid in Bitcoin rather than their own IOUs, which they have infinite supply of? Governments obviously have to tax in order for there to be sufficient scarcity for the IOU to maintain its value, but it's not to make it able for the governments to spend more in the future. Moving on to the second theory of money, which seems to be applied by Bitcoin provenance. It's the notion that money is memory. It's based on a pre-cryptocurrency article written by Narayana Kocherlakota, who's the head of the Minnesota Federal Reserve Bank. He wrote an article called "Money is Memory," where he argues for that fiat money has, although it has intrinsically no value, it's useless. It still has value due to it has partly the same properties as memory could have. If we had perfect memory on a public record of all prior transactions, we would be able to tell who deserves something back from society, because when somebody is in this view, when somebody is exchanging real goods and services for fiat money, they are essentially giving something valuable for something not valuable. It's like a gift. But with the public record, we could see who has been giving most to society, and they deserve something when they need it. And this is where we don't have this perfect public ledger of all past transactions of all persons, but we do have money, and this is what gives fiat money value in this view, because it shows a person's portfolio of money shows how much they have contributed to society earlier. And Kocha notes that the government's monopoly on seigniorage might be in some jeopardy as information access and storage costs decline. This is very appealing if you have a database technology, and energy costs are falling. This has been picked up by William Luther and Josiah Olson in 2014, where they wrote the article "Bitcoin is Memory," and they argue that since Bitcoin provides a public record for all prior transactions, the Bitcoin has the alleged central function of money. They write that Bitcoin is capable of facilitating exchange in much the same way as traditional hand-to-hand currencies. They predict that when financial sector risk raises expected costs of storage of traditional money, they take the banking crisis of Cyprus as an example, where they show that the interest in Bitcoin rose prior to the haircut that was believed to be forced upon depositors in Cyprus banks, as a way to make capital flight. So they predict that when storage costs of regular money rise and/or the storage cost of Bitcoin falls, people will turn to memory or Bitcoin instead of regular money. But I believe that this thinking of money is a misrepresentation of our payment system. This memory view is backward-looking, because it is claimed that when people transact, they judge the deservingness of the people they are transacting with. Have you contributed earlier to society in some way or somebody in order to obtain your money? But it does not ask, how did you get hold of the money? Was it a fraudulent activity? Did you get credit from a bank? As is becoming more and more known, private banks create money by lending. So this is an endogenous process. So in that sense, it doesn't really make sense to think of money in this way. On the other hand, credit is forward-looking. When credit is giving and money is credit, you ask, will the person be able to pay back the debt with interest? So this is a judgment about the future. As Schumpeter noted in 1934, usually someone can only become an entrepreneur by previously becoming a debtor. This does not seem to work well with the theory of money as memory. On the other hand, our payment system is better described as an ever-changing web of IOUs with specific legal relationships of future promises between two economic agents. As Torbjørn noted, Bitcoin is not a financial instrument. It's not the liability of anybody. There is no issuer, personal issuer or institutional issuer of Bitcoin. It comes from an algorithm. In that way, it's better to think of Bitcoin as a real asset. When you think of what is Bitcoin, it's more closely related to gold or tulips than it is to what makes money in our current economy. As I touched upon, we have an extremely elastic monetary system in place, perhaps too elastic, as witnessed by the bubbles that seems to be reoccurring. And it works that in the way that banks can extend credit to credit-worthy applicants, as they are backed by the government as a lender of last resort. As such, banks are a public-private partnership rather than a purely private sector corporation. As mentioned, loans create deposits, so whenever there is a credit-worthy company or individual with a good project or sufficient income to pay back the loan, money can be created for this purpose. This is very beneficial if credit is created for the correct purposes. This means that we can have a dynamic capitalist economy. Maybe there's been created too much money to purchase houses, existing assets. No, these are not productive purchases, but theoretically for productive companies as well. So we have to limit imprudent and dishonest credit creation, as has been plentifully witnessed before the financial crash. But we should not eliminate credit. We should manage credit. This is basically what we learned from Bayshot in when the lender of last resort function was really set up. So transferring to a Bitcoin economy would result in a fixed money supply. This is claimed as a virtue of Bitcoin, that like gold, it cannot just be made out of thin air, and like fiat currency, it's not as fragile as such an economy. But if you want to think about how such an economy works, the closest you would get is maybe the Southern European Euro economies, and you have to imagine that after the crisis hit and before Mario Draghi and the ECB entered to ensure their finances, if they were not allowed to get credit, but they had to finance everything from taxes in order to restart their economies, then you would get kind of an idea of how this economy would be working for states. So when there's no injection or destruction mechanism that takes the needs of the economy into perspective, there will inevitably be price volatility, as we have also witnessed. You don't know what the price of Bitcoin will be in a week from now, and this makes it useless as a unit of account. Imagine if you had signed a contract, a labor contract in, let's say, 20th of December, you would be pretty critical of your wage today. And this raises some serious questions that I hope we can maybe get some good answers for today. Namely, how will entrepreneurs access money to start up productive activity? Will there be lending in a trust-free environment? Because there's always a credit risk whenever lending takes place. And will there be intermediating institutions to facilitate this? And how, if so, how will there be financial stability without a lender of last resort behind? So, in conclusion, governments gain access to real resources by imposing taxes in its own unit of account and paying by extending credit. It's a political power-based invention, not a spontaneous market phenomenon to lower transaction costs. A Bitcoin economy would limit government's ability to fund itself and stabilize economic activity, and it would be a return to a gold standard economy with a random money supply. There might be some use cases for blockchain. I'm completely open to that. I'm not a tech expert as such, but it seems more right to me to think of the possibilities in limited access systems, such as in value chains, or established corporations between companies. There have been some attempts by SWIFT to make corporations between banks work for international transfers, which are not very efficient at the moment. But it seems not to be working so well because all banks need to have the same back end There are some technical difficulties, but they could theoretically be solved. So to my last slide here, hopefully to spur some good debate and some questions from you, or maybe some answers from you. I would like to know, why should governments accept anything but its own liabilities and taxes? Why would the citizens want the central authority to be unable to stabilize economic activity? There might be differences whether you live in a democratic society or not, but it seems that this is not needed in Norway or Denmark, where I come from. And I would like to know how one would ensure financial stability and economic activity when the money supply is fixed and or arbitrary, depending on what cryptocurrency you are using. Thank you.
Okay, so you still with me? Yeah, everyone looks more or less awake, so there we go. That's a good start. Right. I have one question for you, Torbjørn.
Yeah. Only one?
We'll start with the easy one. No, actually, it might not be so easy.
Yeah.
Those stone money that they had on Yap, how big a canoe would you need to move that massive stone that they were standing next to? Because that looked like one big stone.
How what?
How would you move that massive stone on a canoe? I mean, I couldn't imagine the size of canoe you would need.
They had loads of canoes.
Oh, they tied them together.
It was really tough work. And that's it was really tough work, and that's what made it scarce and capable of serving as an indirect record of who had contributed. Because if you owned stone money or seashells, you either had worked a lot acquiring this stone, or you had given someone something of value, or you'd been a gangster and stolen value. That's how it could work as an indirect record when other stronger institutions were lacking. And shall you have more questions, or can I comment on the presentation? Or please. Yeah, so I have some general comments. And the first one is this misconception in my mind that something is either money or not money. I think it's very useful to think about money as moneyness, where different objects have a degree of ability to buy. It's not an either-or question. The other thing is the idea of there being only one money at a time, which is very easy in a model to have only one kind of money. But in reality, we have all kinds of monies. Norwegians use foreign money when we travel and interact with the rest of the world. We seldom use central bank money. We primarily use credit money created by the private banks. So we have all these kinds of different monies that have coexisted and served different purposes and intermediate different social relations. Historically, within a country, you used the fiat currency of that country because that's been a relatively stable society and you've had the tax liability. But when countries have had exchange between them, most of history, they've used a commodity money system like gold standard because they didn't trust in other monies issued by a sovereign. The period we have had since 1971, where the US dollar has been the world reserve, is very unique in a historic context. So why have we used commodity monies between countries while we used fiat currencies within a country and we used memory within a company? Because we have different degrees of trust, different degrees of institutions enabling us to interact in these different settings. So my point is that Bitcoin will not overtake the Norwegian kroner unless the Norwegian kroner becomes like the Bolivar, which in Bolivar, coffee has appreciated as much as Bitcoin did in dollars last year. But as long as the kroner remains stable, we will use kroner within Norway. But Norwegian shipping companies who want to send money to a company in, for instance, Iran or Syria or somewhere at the other side of the world might use Bitcoin as a value carrier or like, yeah.
Would you like to comment on it? Or? Yeah.
I definitely agree on this notion of moneyness. There are different kinds of monies, and depending on I would say the most essential feature here is the acceptability of the token by others. This is really what makes it circulate. And so, what's at top of this hierarchy? At all points, it would be the thing closest to the unit of account. In a fiat economy, that would be like Norway. It's the Norwegian kroner. So that is what all the money promises are denominated in. All the lower promises, that of companies or that of the bank money, you are promised the money higher in the hierarchy with the most moneyness, and that is the one you can pay your taxes with. That is the ultimate necessity of possessing money. You could also be you could have politicians that, like in Venezuela, who decide to fix your exchange rate to something. It could be a commodity, like under the gold standard, or it could be to a foreign currency. I'm from Denmark. We've fixed our exchange rate to euros, so this actually means that we have placed the euro on top of the hierarchy of money in Denmark, and we are in a fortunate position that, unlike the 1970s, our exchange rate is undervalued, meaning that we have a huge trade surplus to the rest of the world, meaning that even though we have a fixed exchange rate, we still have fiscal autonomy within our own borders. We don't control our interest rate, but our government could spend more money right now than it does right now. But this is really one of the problems for the Venezuelan economy, that they're making promises in US dollars. They have debt in foreign currency, and they are promising to exchange their own fiat currency into foreign currency. This is not a way to create a stable economy where the state has the power and the policy space to fulfill the societal needs of its citizens.
I have maybe one extra question I would like to sort of put in there, because one of the things that we've touched upon briefly is the stability of the financial system as especially Bitcoin becomes more prevalent. And one of the things that I've been thinking about is that before, if you had a currency of Zimbabwe, for example, that suddenly experienced big problems, okay, that would be a problem if you lived in Zimbabwe or you were trading a lot with Zimbabwe. But the thing is that with Bitcoins, this is all over the world. And so the more use it gains, of course, it will also start impacting the financial system more in case it experiences trouble. So is that something you maybe want to talk about?
Yeah, the relation between financial stability and Bitcoin is very complex and very difficult, so I don't have a good answer there. On the one hand, if Bitcoin becomes relatively common, you'll start to see, and you already started to see, derivatives being written over Bitcoin. You'll see debt contracts denominated in Bitcoin. And these debt contracts come with the addition of an interest payment. So in the creation of that debt, let's say it's you create a debt contract that gives the borrower 10 Bitcoin, but he owes 11 Bitcoin. So you'll build up a net claim on a fixed base. That can become very unstable, and it's what we saw with the gold standard, where you had credit money creation on a fixed monetary base. But that requires Bitcoin to become a unit of account, at least in some situations, and I don't think we'll see that in any near future. On the other side, the mere existence of Bitcoin as an alternative to bank money or national fiat currencies makes it easier for a population, especially if you lose trust in the banks or in the government money, to escape that. It's easier to leave the national currency system. Earlier you used dollars, but those are physical, so you need to get them in there. It's easier to get the Bitcoins in. On the one hand, that could be destabilizing in the sense that it makes it easier to run out when you want to run out. On the other hand, just knowing that it'll be easier to run out is kind of policing in a sense. It's kind of limiting the kind of behavior that governments or banks might be willing to take. So it's difficult to know whether easier access to leave will be destabilizing because people will leave faster when you have a crisis, or whether it will limit the likelihood of a crisis to occur in the first place. It's probably both.
Yeah, about there's definitely a use value in for people who want to escape government regulation and whether you see it as legitimate or not. So there would be people who want to hide away from taxes they regard as illegitimate and want to have their capital, for instance, like in Cyprus, take it out of the country before it is reduced by a tax. But as I see the world, as I see it more politically, I see instead of this crypto libertarian notion that it's good to let the people evade the decisions in the political system, people should mobilize. People should change the politics. The Swedish government should mobilize with other countries who also want to make affairs with Iran and put pressure on the United States, or find different ways. I'm not sure making it possible to evade taxes and such is the right solution to these problems. And especially the case with Cyprus is interesting because the problem is that they're part of the euro system. If they had their own currency rather than an effectively foreign currency, they would not be in the problem in the first place. So I keep coming back to this, but that is really the root of the European mess after the great financial crisis and the post-sovereign debt crisis. It's not a coincidence that it was countries in the Eurozone who were hit by the sovereign debt crisis, while Japan had a public debt of 250% of their GDP. This is because they are not issuing their own money.
But then Iceland issued their own money, and if you had your salary in Icelandic kroner, you would more or less overnight find your wage cut in half, because an Icelandic consumer, all you consume more or less is imported. Like you have a local house, but food, everything is imported. So it's not necessarily stable, even though you live in a democracy, the national currency. So what I'm arguing is not that Bitcoin is all good. It'll be used for purposes I don't agree with, which I don't think are good at all. And I don't think Bitcoin will replace stable national currencies, but it will replace unstable national currencies, or be an option. If you lived in India last year, you would experience the government saying that within the next 4 hours, 80% of the cash you have is demonetized. They demonetized the 1,000 rupee and the 500 rupee in a time span of 4 hours. You'll be allowed to exchange into new rupees after a couple of days in your local bank. But we're doing this to take away the value of all the criminal cash out there. How do you separate? There are stories of people in India dying because they couldn't buy their medicines. When your government is doing that, the volatility of Bitcoin seems less scary.
You want to counter that?
I totally recognize that if your government is acting totally irresponsible, mistreating its own currency, the hand which feeds it, the government, then people will look to other assets. Might be crypto assets if they have value at the time, and there might be a chance to get a capital gain in the meanwhile. Why not? But the problem is that the problem is politics. That there's not sufficient accountability and public pressures on how to conduct public policy. The incidents you mentioned is a government default, that they will not honor their own liability in payment of taxes anymore. This is a government default. Why would you believe that the promise is any good in the future? This is a terrible strategy if you want your IOU to circulate as money.
Just before, very short. Try and keep it short. Menon will go to question.
Yeah, I completely agree. And I want to take this back to the theory again. So you had this linear theory where you start with barter, and then you have commodity monies, and then you have, depends on which book you're reading, fiat currency, credit currency. So it's one way to read it is as an historical account, and then it's probably completely wrong because people started to live in families, and within a family you start with memory, and then you expand your exchange a little bit, and then you can use credit because you have rapid interaction over time. But then once you so my reading of this line is not historical, but kind of institutional. When you have zero trust, you have to exchange value for value at that point in time. But once you have a little bit of trust, sometimes you interact, you can start to use something as money. In situations where you have even more trust, so my thinking is that if you look at it as a hierarchy, where you can use more and more efficient money forms, the more trust you have, the better institutions you have. Then you can start to understand why Bitcoin will have a place, because we don't have Norwegian stable government and democracy all over the world. Recently there was a report on corruption showing that I think it was 85 or 75% of the population lives in countries which are scored as highly corrupt. In those situations, something that could substitute for lack of trust could be very useful.
Okay, we're gonna thank you for that. We're gonna go to the floor real quick. We have one question down there, question from Julia over there, and there's one in the back.
Yeah, thank you. We have lots of questions, and I'm glad to hear it, because the idea now is not only that you can ask them questions, but we will also be hoping that we'll have debate back and forth in the audience with different perspectives. So yeah, excited about your comments.
Thanks. Yeah, great conversation. Thank you. It's really important to be fleshing out these tensions. I just wanted to extend a couple of ideas, or just put out some new ideas to you, which is the gold standard, Bretton Woods, and even internal company transfer processes do use governance structures and units of account and complicated treaties between governments. And even down at the household level, it's not like there's some consensus amongst egalitarian people about memory. You're talking about a patriarchal system where a man makes a bunch of decisions about the economic logic of the house. So I'm not sure the history of these voluntary internal organizations is accurate there, but in terms of Bitcoin, one of the things is it doesn't have a governance structure. People like Angela Walsh have talked about this. If you set up a nuclear reactor and there's nobody responsible when it goes wrong, you've set up a bad governance structure. If we're having the global financial system where it could collapse because a coder makes a mistake and there's no one liable, we're doing something very dangerous to our public infrastructure. The other question is about the anonymity, because I'm actually quite supportive of anonymity and privacy as social goods. But even Milton Friedman talked about it as cash equivalent. He wasn't talking about private assets. He's talking about a government fiat instrument that exists in digital form. And the questions of privacy and anonymity are ones that require a public conversation, because you still have a court system and property rights. You can have a country collapse and the land rights, which you are then basing your trading on, are going to go away, your property rights. So I don't see how you can have a world, if you don't trust governments at all, where people actually own assets that can then be traded. The property rights precede the currency in terms of the ability to actually have an economy, and that requires a government. So it seems like we're sort of trying to pretend like we can imagine a world without a government, but it's always going to come back in the legal structure of the economy.
Thank you. Then we had a question over there.
Richard Senner from the ETH Zurich. Thank you very much for the interesting talks. Question to Mr. Jenssen. I agree that there's definitely no black and white, and there might be a hierarchy of monies, shadow banking, etc. But then in your talk here and there, you suggest that Bitcoin could become something wider, more inclusive. You talk about 2 billion unbanked people, and you're using these examples from Zimbabwe and also from Iraq. But for example, if you have a closer look at the northern Iraq example with the Swiss dinar, it's not really an example of a successful currency. In contrast, the local authorities they had a lot of debates about the appreciation of the Swiss dinar. It was a big problem, and northern Iraq took part in the Food for Oil program with the United Nations. So a lot of local production was substituted with goods and food imports. So the Swiss dinar is an example of a very bad currency. It might not be as bad as the new dinar that was used in the southern Iraq with hyperinflation, but the Swiss dinar is definitely not a a good example for whatsoever. So yeah, I have struggled with the kind of large-scale benefits that you advocate on the one hand side, and on the other side you say, yeah, Bitcoin won't become the unit of account anytime soon, and I agree. Thanks.
Thank you. And then we had a question at the back.
Yeah. Do you think you'll manage more questions, Torbjørn, before you have your rank down? Good.
He's got the pen going.
Could be also a question for
Okay, thank you. It's interesting to listen to. My name is Arild Vatn. I'm from the Norwegian University of Life Sciences. First of all, with second Rowan on the...
Move it away from your face a bit.
Maybe I have it too close, or I'm too close to something.
too close to the speaker.
Let me... Yeah, I can sit down. Thank you for... No.
Maybe just without the microphone and
Yeah,
taking it
I think it maybe I've got some advice here that it works better if I turn it like this. Okay, thank you. First of all, second Rowan on the thing that memory is actually also partly at least supported by authority. So in the firm, you would always have that kind as a last resort. A company is some kind of a command system, even though it doesn't work if you don't have trust. So that was just a comment. My question regards the effect this would have for unstable, you would say, economies and political systems. Because one of the things that I've been afraid of is exactly that it will take over in the countries where you need to build a state. And you can get into a very, very bad so-called equilibrium here. And how could we in some way solve that problem? I mean, it's very difficult because you don't have any power that could actually, at least the way we have it now, intervene and handle this. So I think the countries in the south could be, at worst, very exposed to this system.
Thank you. Torbjørn?
Answer the questions from the last one and back to the first. So countries will have their power limited by every option. So if the population can use dollars, it'll limit the government's flexibility in their monetary policy. The same thing with Bitcoin. Whether that's good or bad is a very difficult question. Because as we heard earlier this morning, a mafia boss could force you to accept his money by putting a gun to your head, the same way the government does. Is that good or is it bad? It really depends on the perspective. I'm not saying it's good, but it's those who find themselves limited from doing the transactions they want will seek alternatives, whether we like it or not. So it's a reality which governments have to meet by building better government. They have to be competitive. They have to outcompete alternatives by providing structures that are viewed as good enough by enough of the private sector and enough of individuals. So there's no easy solution to that. On money as memory, of course it needs hierarchical power. That's my argument, is that the stronger your hierarchical power system is, the better memory can be used. And of course within a family there can be power relations. My point is just that when you have a strong institution, which tends to be associated with power, you don't need these substitutes, which doesn't rely on power. And then it was the large-scale benefits for the poor in the world versus the dinar. Again, it's about whether the dinar was good or bad depends on who you asked. The people who decided to continue using dinar, despite the government wanting something else, did it because they found it favorable. The local government didn't like it because they lost control over the economy, and you had an appreciating asset, and they were afraid of. I know. The northern government didn't like. Well, if nobody liked it, individuals wouldn't hoard this money. They hoarded it because they found it necessary to hedge themselves, to have liquidity in case of something worse happening. It was an individual decision. And my point with that example is to show that money can emerge despite the local government and the central government's wishes based on what individuals want, be it good or bad. I'm not saying that it cannot come out of government and central authority. I'm just saying it can also emerge in the market and emerge from private decisions and then feedback loop from network effects where people continue to agree. So no government, no ownership rights. Well, clearly, if you don't have any authority, you'll have anarchy. And out of anarchy, you'll have hierarchical structures emerging very quickly. Because hierarchical structures are more efficient. People will find together and they'll reconstruct new hierarchies. I think that innovation in Bitcoin and the Bitcoin's blockchain is challenging a lot of the hierarchical structures we have today. I don't think it'll be flat forever. The same way that the internet in its early days democratized flow of information. Anyone could suddenly put up their own web page and put up their own TV show or write their own news articles. But on that internet, you also had a Facebook emerging as a very centralized, very hierarchical structure after a while. I think we'll see the same in the cryptocurrency world, where it's now at the beginning, it's very early days, it's very tech-driven and speculative. Then we'll see some flattening, and then we'll see some re-emergence of hierarchical structures. This is a pendulum swinging back and forth throughout history, I think. No governments in Bitcoin? I completely disagree. Bitcoin is only what people choose to use. The government structure is very close to an open democratic process where you have to try to convince others. You don't have a vote, one person, one vote. But on the different forums online, people try to convince. You also try to convince by aggressive measures where you attack a currency on an exchange by manipulating the price. But you have this open competition between all the different currencies and the cryptocurrencies and alternatives, where it's people who choose what software to run. And it's that software which forms and ends up being Bitcoin. So I think Bitcoin has loads of governance, but it's rules without rulers. And power always present? Of course.
I'd like to come in on the last part. The idea of just changing your monetary unit whenever you don't think the current one suits your purpose. Money is supposed to be an infrastructure to enable all the things that matters. And what this swapping of coins and swapping of money, this is really the financial or monetary equivalent to building new railroads next to the old one. Whenever you don't like how the railroad company is conducting its business, we need one system that works. And I don't see the appeal of having a system where you would enforce your political will by switching systems all the time, supposedly, or sometimes just. About the developing countries, I suspect that was what you were meaning, right? This might assist capital flight pressures, but when talking about from this perspective that I've been representing today, when thinking about developing economies, there are certain things that we should do first of all to help these economies succeed, and in short, it's not what we've been doing through the IMF over the last 30 or 40 years. First of all, we should let them redenominate all their debt into their own currency, so they would not be in a position where they were dependent on exporting to obtain the foreign currency in order to pay their debts, which are gaining interest. Second of all, we should still provide foreign aid. That the claim that sovereigns with their own currency can obtain full employment, that's not enough if you're an underdeveloped economy. This means that we should use our foreign aid to provide them the finances for capital imports from abroad in order to raise the productivity in these economies. We should not be through our foreign aid programs having Westerners building wells and schools and such. They should do it themselves. We should export expertise whenever it's needed, but that should be the fiscal responsibility of the local governments in their own currency. So they just have a one currency circulating. We've been interfering in their monetary affairs, partly through IMF and the World Bank.
Thank you. I have one question for you, Aske. Actually, I was reading an article that you wrote recently, in which you were talking about Bitcoins, and you were talking about how they, at least the way I read it, had two functionalities or two purposes. One was to be sort of anti or money laundering vehicle, and the other one was to be an investment tool for sort of high speculation. So I was just wondering, do you see any other beneficial purposes to Bitcoins, or is it sort of mainly negative points?
First of all, speculation is very positive for those who succeed, who get out. Let's say 17th of December. I know somebody who sold a big portion just a few days earlier, last December. That's good for him, but not when you're talking about in a societal common good sense. I'm still waiting to see where Bitcoin will make its social contribution. Right now, it seems to be more promising for what I called earlier techno-libertarians who want to escape governments. I totally understand that is a valid goal to have if you're under undemocratic rule, if you're being prosecuted for your beliefs and such. That I understand this purpose, and that is beneficial in that sense. But we should not be this is a notion that's going through all society. We need to be resilient. We should rearrange our own affairs in order to cope with the problems that we face in society, climate change and so forth, rather than solving the problems. And that is really, I believe Bitcoin is a symptom of this general feeling.
Maybe Torbjørn, you would like to come in on this. Just as I let you respond to it, I have a sort of follow-up to this. One of the topics that you mentioned in your presentation, and that I've also heard before, was the idea that this would be a tool for people excluded from the traditional financial system. And I know that was, at least to some extent, one of the founding ideas behind the Bitcoin. However, the way I see it today, this has not really materialized, and you see a concentration of the people who own Bitcoins to, 1,000 people who own 40% of all Bitcoins these days. So what is your reaction to the way that Bitcoin as a concept has developed these recent years?
So there's no doubt that Bitcoin primarily, till this day at least, have been beneficial to those who already have strong economic position. Investors, gamblers who were lucky in rich countries. But there are also stories about people who's been using subsidized electricity in Venezuela to mine Bitcoin, so they could go online and buy food online and have that smuggled into the country. We're in the very early days. This really hasn't taken off in developing countries yet, and especially not amongst the poor. When we see it taking off in developing countries, we see rich people getting their money out of there. But that's where it starts, unfortunately. The same way where it's been used for criminal activity. The question is, what do we do about this? We can try to make this illegal, and then only those doing illegal transactions will use it. Or we can try to give our government the best tools possible to find out who's hiding away from taxes, to give tools to the police to find out, Bitcoin is not that anonymous right now, so they can track transactions when there's a illegal transaction, and try to find regulations where we can get the best benefits, where we actually can develop self-sovereign electronic IDs, where we can avoid capital controls, allowing us to send help to countries blocked from the financial system. And that takes me back to this railroad. Of course we need only one railroad. We need one standard. We need one global payment system that works for everybody. But no one is providing that. There's loads of people who's come to the station and they're told, sorry, You cannot board this train. Yesterday I did a presentation, or I saw a presentation from a guy from Finanstilsynet, who was talking about how great M-Pesa, this mobile money that emerged in Kenya and Tanzania, is, because it gave electronic payments to the masses. But it was anonymous. Because a phone credit, you don't have to tell who you are. And it could really take off because it was anonymous. So then I asked them, could we imagine this kind of anonymity in Norway? And they said, no, no way. Digital money needs to be surveilled. Well, so our current system is not giving us the railroad if we want privacy when we use money digitally. It's not giving us the railroad if we want to transfer that money to Iran, Venezuela, Bangladesh, Pakistan cheaply. So then, unfortunately, people start building an alternative railroad next to it. Technically, it's not needed, but politically, I don't see a way around it. And those who are denied access to the train, they will try whatever they can to build a poorly built railroad right next to it, and it'll be very crap in the beginning, but after a while, especially since Bitcoin is an open system which allows for permissionless innovation, you'll see it becoming better and better and filling the needs, the real needs, not just the speculation, better and better in the future. At least that's my hope.
I'd like to comment briefly on you mentioned this Bitcoin is the early days. Bitcoin has been here for 10 years now. This is the 10-year anniversary. And I'm still not feeling any impact on my life. And there might be some in Venezuela, as you mentioned, but I'm not saying this is your argument, but you regularly read comments that Bitcoin is in the same stage as internet in the early days. You've probably heard this. There's so much promising potential. It could be the new internet in a new kind of way. However, internet revolutionized people's lives in very short time. People started sending email and communicated in new ways.
I really need to comment on that.
You will.
In 1970, TCP/IP was developed. It wasn't until 1990 the internet we know today really started shaping up. And it wasn't until the 2000s it really started to have economic impact. When Krugman was interviewed in 1998, his prediction was that the internet, by 2005 or so, we would understand that it would have no greater impact than the fax. The boss of SIS said in 1996 that checking in on an airplane would never be done online. An interview with David Letterman and Bill Gates in 1995. It was super easy for Letterman to ridicule Bill Gates, even though he's a pretty funny guy. Because when he asked him about this internet thing, he had heard that there had been some breakthrough that you could send a baseball match on the internet. Where Letterman said, well, does radio ring a bell? And the poor Bill Gates tried to say, no, it's different. You can listen to it later as well. Does tape recorder ring a bell? And to see Letterman having such an easy time ridiculing a mind like Bill Gates as late as in 1995 really puts this into perspective. I think 9 years of development of a fundamental new protocol, solving a problem that nobody had solved in decades, which is being able to sort transactions in time in a decentralized network. Nobody had solved that in computing. And 9 years is very early days.
Okay, thank you. Then we're gonna quickly go for another round of questions. We have one over there, man in the green shirt. Or the multicolored.
My name is Anniken Seip. I'm a retired IT security person from the Financial Supervisory Authority. And I get distracted by some of the buzzwords, and I wonder if BI could do some more research. For instance, you say Bitcoin is democratic, and I find that it's anarchistic. What do you tell me?
Sure.
Maybe please correct me.
No, sure.
So I get distracted by hearing the wonderful word democracy. And also digital identities. I get back to 1973 when we learned about asymmetric cryptography. And it was so simple and elegant. And when we started to try to use it, we had to use a third party. It was, you could use it in a closed circuit, like you're talking about here. But when you want to expand, you need somebody to trust. How should you identify a person first? Thank you.
So short comment on the last part there. Up until Bitcoin, it had to be centralized. You had something called Suku's impossible triangle for domain name. But the domain name is basically a username. It's no power. Or is it working? No. Where you could have a system which could have 2, but not 3 of human readable, decentralized, and secure. The asymmetric cryptography you're talking about, that's the link between the secure public key and the human readable name. But that list had to be stored in a central server by a central authority, which is the reason why there's one organization in the US controlling all the domain names of internet all over the world. But with Bitcoin, you can take that list and you can write it into the public blockchain, into the public record. So you can prove cryptographically secure your human readable name without needing an intermediator. And that wasn't possible before. That was technically impossible. That's one of the great breakthroughs with this technology.
Thank you. Let's take 3 questions and then come back.
Hi, my name is Torbjørn Bull. I'm previously with the central bank, now with Levy Institute in the US. You talked a lot about private and public infrastructure, and I was just wondering if you had any view of whether the central banks should start going into cryptocurrency themselves. Thank you.
Thank you. My name is Rune Wingard. I'm from Roskilde University. My question is related to the energy consumption of Bitcoin. Currently is at the level of the island energy consumption. And I'm just wondering, in an age of rapid climate change, isn't there some problems with this radical rise in the use of cryptocurrencies, Bitcoin especially?
Hi, my name is Jana. I actually just graduated from BI recently from the executive program MBA. But my question is around regulation as well. I'm coming from private banking, and I know that we have strict sanctions against doing business with various countries. And with Bitcoin, it seems as much as it could be a positive, it could also be a catch-22, and it could be used adversely. And so I'm just wondering, in general, what do you foresee to be the biggest issues with this digital currency worldwide if it was to take over? Because with disappearance of paper, for example, Norway keeps talking about going paperless and maybe one of the first. So I'd just like to see your take on that.
Okay, thank you. Asger, would you like to comment on any of the questions?
About the central bank digital currency, first of all, I believe if this should be a cryptocurrency, a distributed ledger currency, this seems like an oxymoron to me. I don't understand why a central bank would be interested in having its ledger shared, because it trusts itself. It's the highest authority in the monetary system. If you don't trust yourself, you should just shut down. That would be my first point there. I don't know if you want to get in on this.
Completely agree.
While we're at it.
And I also think I completely agree, but I also think the central bank really should issue a digital currency to the population. Because we have a central bank law in Norway, which makes it illegal for private banks to issue currency, like paper or coins. But then the world suddenly became digital. And the central bank cannot issue digital representation of cash to the public. But the private banks can. They obtained a monopoly of issuing the money we're using today. And I think that's very strange. I think they should compete with, the central bank should have an option. So as a Norwegian, if I decide to, if I want to, I should be able to hold an electronic claim on the central bank.
Could I just put one extra comment in there, maybe to you as well? In this time of cybercrime and cybersecurity issues, wouldn't it in some ways be better to make sure that you have several copies that have to be the same, even though the central bank holds one of the copies? I mean, what would be the problem with having other people also having the copies?
I've not witnessed in a developed country that it was a problem. I might be wiser, or Torbjørn might.
Hack of central repositories.
It hasn't happened yet.
Equifax. Barclays.
Oh, I'm talking about central banks.
Yeah.
They're within their systems.
Yes,
Bangladesh.
was, yeah, huge.
I won't be. Yeah.
And it will happen. So, but that's a technical question: how to make it secure enough, rather than a conceptual question. Conceptually, I think you're talking more conceptually that the central bank could maintain this, and then technically you have to ask IT security engineer how to implement it so it's robust and secure.
It would be great to have backups. Obviously, that's what we're talking about. It's not a fantastic innovation in any way, but this talk about the central bank digital currency also relates to whether we should stop having paper money or physical cash that you mentioned. What cash offers right now is anonymity, and that is not just for criminal purposes. Obviously, that's what the Indian the government of India is worried about. But it's also if a husband wants to purchase something that his wife should not know about. We may laugh, but this can be very important to having a joyful life in society. So. And I will not go into details about that, but
that's why we need
but that we may need to be looking at how there can be central digital cash, but in an anonymous way. I know Rowan has a project going on about that, but that's how I view it.
Technically, that's super easy. Politically, it's very tough. The central bank could very easily, technically, issue an anonymous digital currency. But politically, that would be extremely difficult. You had that digital anonymous currency back in 1990. It was called eCash. They used public cryptography to keep the users anonymous. But they didn't use transferable proof of work. Instead, they used bank money. They used dollars, which meant that the system was centralized because they had to have a bank account. And therefore, it was shut down because criminals started using this. So the government has been able to create anonymous digital currency for a long time. Until now, they haven't chosen to do so. And it's primarily a political issue, not technical. Maybe you should answer also the question.
There's one thing that worries me about this cash-free society. It's that the neoclassical economists have been, in their mind, all that matters is the interest rate in the economy. So while we've faced an enduring recession or depression of the economy, especially in Europe, their answer has been, we need negative interest rates because that will force companies to invest because it's so cheap. But that's really misunderstanding how the economy works, and these negative interest rates were believed we needed to abolish cash and thus anonymity. But this is a movement that I'm quite afraid of, and also we see we're in a process of democratic backslide. You're all aware of this. I'm not sure that I think it's a good idea that we have accounts at the national bank in this environment. I understand why the Chinese are very interested in having a financial system in this way, but if there should be central bank digital currency, there must be some serious safeguarding of anonymity.
I want to follow up on that as a real discussion where we actually go along with what's being said right at the end. Because one of the good things about central bank digital currency is that the public is much more concerned about the central bank or the government misusing that kind of scheme for surveillance. But when you have mobile money, for instance, like Ant Financial's Alipay in China, which is performed by private companies, or data collection as done with Facebook, it's not the same scrutiny from the public. And then the government says, it's okay that you collect this data as long as you share it with us. In China right now, it's extremely scary. They're working on something called social credit score, which the government is planning to launch in 2020 or 2022. But what's happened is that Ant Financial, this mobile money platform, which a lot of Chinese people use for all their purchases, they've already launched the social credit score. This is a number which is updated once a month and limits your access to different services, sets the prices you have to pay. Nobody among the masses really know exactly how it's calculated. But for instance, if you have friends with a low score, your score will become lower. I think this same thing is emerging and will emerge also in the private sector in Norway. You see health insurance that are cheaper if you share your Fitbit data. Or you could flip it around. You have to pay more if you don't share your Fitbit data. I don't think we will see the same emerging from the public sector because the population wouldn't accept the Norwegian government imposing these kind of systems. So I think it's important that that we have systems under direct democratic control, which will make it easier for the public to say that this is not okay, because for some reason the public is more afraid of government than big corporation, and I think they should be afraid of both. Now I can get back to the questions. Energy consumption. Energy consumption is clearly a challenge for the environment. But I think the solution to that is higher taxes, especially on fossil fuels. Not saying what you can spend that energy on. So if the private companies find it profitable to spend the energy on mining Bitcoin, that's okay. If it's from an environment perspective at least. If that's too polluting, the government should increase taxes on that electricity source. If it's done by hydropower, fine. Another thing is important to know is that the energy consumption is not directly linked to the number of transactions. It's linked to the security of the system, but not the marginal transaction. Especially with these off-chain transactions, which are enabled by Lightning Network, you can scale to millions of transactions per second without increasing the energy consumption, which is important to have in mind, because otherwise, if this were to take off, it would use more electricity than what's currently available on Earth, and of course, will not get there. And then anonymity and money laundering and speculation. These are the dark sides of cryptocurrency. These are the dark side of this technology, and there's no denying it. Internet is used for a lot of really, really bad stuff. Cars are used as a means of conducting terror. Phones are used to plan all kinds of terrible stuff. So with all technology, there will be some good effects and some bad effects. That's not unique to Bitcoin. That said, a lot of the critics tend to start off by saying Bitcoin has no real value. It's too volatile. It cannot be money. And by the way, all criminals are using this for money. And everyone who wants to avoid taxes, they put all their wealth in this thing that's not money. You cannot have both of those at the same time. We're probably somewhere in the middle. But this really shows that some critics turn off their logical sense facing this new thing that they don't understand, and they cling on to all the negative things. I don't want to tell you that Bitcoin is good. I want you to tell you to take it seriously. To ask the questions, why is it here? What can it become? Not only what is it now or what was it yesterday. How can we make sure that we get some benefits from this while minimizing the negative effects? Not just write it off as some tulip.
I think, correct me if I'm wrong, but on the energy question, as far as I understand, some of the miners of Bitcoins these days have actually started to switch off some of their mining equipment because of the price that the Bitcoin is at sort of equals out with the price of the energy that they would use to do the mining. So,
and it's still using less energy than mining of gold. And gold is only one of the few things we waste energy on, because we dig it up, to put it back down in the ground in volts. You have to quit? No.
Okay, quick comment on the energy side of this. If I don't think that raising taxes on energy is the right response to wasting a lot of energy on verifying transactions on the network that's not supposed to be money in your country. Because taxes would presumably be raised all over the board, I guess. I don't know your thinking on this, but this would hurt people who interact in more socially useful activities as well, and in their homes.
The electricity and the hydro plants are owned mostly by the different communes. If they allow Bitcoin mining, they're doing that because the Bitcoin miners can pay a higher price for the electricity, so the commune earn more money. And also, a Bitcoin miner can be very easily switched off and back on again, which is very good for stabilizing the electricity, because electricity is a market where supply at all time has to be equal to demand. In Norway, we have hydropower, which is relatively stable. We have special contracts for aluminium industry, so they can be turned off during wintertime, during peak demand. But when you turn back on an aluminium oven, it takes a lot of electricity to get that liquid again. That's not the case with Bitcoin. And if you look at Europe, with a pretty big mix of unstable renewable energy, having small components which you can turn on and off to stabilize the energy consumption over the day, over month, and monetize that could be very, very useful in the electricity grid.
Do we have time for some more comments, or no? Okay, well, there we go. So thank you very much. Give them a big hand.